Good morning, good evening, good afternoon. Thank you again for joining Digital June. If you are the first time joining, I welcome you for sure. We have over 1,200 registration for this conference, and we are very excited to have very interesting sessions. We already had 5 sessions happen previously. 2 days ago, we started with a broad view of digital economy, and then we discussed different investment structures and M&A and how to enter digital economy in India, all those issues. Yesterday, we looked at the regulatory aspects for the platforms, so different OTT platform and e-commerce platform and all that, to look at what are the regulatory issues in digital economy. And then we also talked about in the session number 4, we talked about data protection, data sharing, data privacy, security, all those issues, because digital economy is driven by data as we know it. So it was very interesting discussion. Earlier today, we looked at another aspect, because suddenly digital economy is getting a big traction or big attention from the antitrust regulation. So we had an entire session on competition law and antitrust related to digital economy. In case if you missed them, you couldn't attend them, we will be providing you the video links to that after the conference is over. But today we are having, again, another very interesting session, which looks at taxation in digital economy. And equalization levy has become a very important topic, and it's talked about everywhere, especially in India, in Europe, and also US as a different approach to that. So we are going to have a great discussion today. We have a wonderful group of experts talk about tax issues, and let me introduce them. Parul Jain, she is the session chair. She is a leader of international tax practice at Nishith Desai Associates, and she will be leading the discussion on equalization levy and tax consideration. I would like to also point out that this session is supported by International Fiscal Association, which is, again, an international, very prestigious organization. So we appreciate their support. Along with Parul, we have 4 experts. Dr. Dhruv Sanghvi, he is a leader of international tax and international tax litigation practice at Nishith Desai Associates. He is based in Netherlands. I also have my colleague Mayappan Nagappan. He is the leader of international tax practice and based in India. We also have Dr. Leopoldo Parada. He is a lecturer in tax law and at the University of Leeds, based in UK. And we also have Mr. Ranjit Bansal. He's a Chief Commissioner of International Tax Department at the Department of Revenue, CBDT. So I welcome you all for joining this panel, and I really look forward to the great discussion we are going to have today. But before I go on to that, let me just quickly mention that the people who have joined here, I have joined in their personal capacity. The views and opinions they're presenting here are their personal views and opinion as of today. Or just like digital economy, our thinking also grows, changes, so not necessarily this will be the view tomorrow. And obviously, these views are their own and not necessarily of the organization where they work. I also want to take the opportunity to recognize our other supporting partners who have made this conference possible, and they include very prestigious organizations like Center for Digital Future, CUTS International, FICCI, IAMAI, IFA, IBCA, NASCOM, Thai Silicon Valley, US-India Business Council, and the Wilson Center. In addition, we also have Brand Capital International, which is the international strategic arm of the Times Group as a media partner. Now, you can learn about this organization when you can visit their kiosk from the lobby. Just click on their logo and it will take you to their kiosk where you can learn a little bit more about this partners. So with this introduction, I would like to hand over to Parul Jain to take the session forward. Thank you, everyone, and I look forward to the discussion.
Thanks a lot, Mihir, for the really nice introduction, and welcome everyone to what we hope is going to be an invigorating session on anything and everything to do with digital economy taxes. I think before we proceed further, and I give a brief about what we are going to discuss today, just to add on a little bit to the introduction about Mr. Rajat Bansal. He does not really need any introduction. He's a very senior Government of India's IRS officer. But the point that I wanted to make was he has kindly agreed to be part of this session here in his personal capacity. He's part of the UN Tax Committee in a personal capacity. And all questions which may be directed to him or any comments which may be made by him will be exclusively on, on the new Article 12B, which is part of the UN model. And he will not be able to comment on any other questions as such. But of course, for that, we have Dr. Leo here, and we have Maya and Dhruv. And we are hoping that we will be able to spice up the discussion suitably enough given the recent G7 communication on how a global consensus may or may not be achieved. So with that, I'll start off with just giving a quick introduction. I'm sure our audience is waiting to hear our really amazing panelists here. Digital economy and taxation of digital economy has come a long way ever since the BEPS project started. It's been almost a decade, and India itself has come a long way from Equalization Levy with Equalization Levy 2.0, with the SEP, the flip-flop on the Pillar 1 proposals, a blueprint which is coming out, the complications around Amount A, Amount B, Amount C, the UN Tax Committee proposing its own, simplified version of how to tackle the taxation issue. The newer issues of what is next is where is value creation taking place, and then with a climax reaching up with the US starting to participate in just when everyone thought US is not coming in, bringing its own concept of what type of companies should be included within a global framework. And what we saw earlier this month with the G7, powerful group of countries taking a cue of the US proposal and starting that off as a negotiation point by stating that at least, on Pillar 1, there would be an equitable solution on taxing rights, with market countries being awarded tax right on at least 20% of profits exceeding 10% margin for largest and most profitable multinational enterprises, and also approving a global minimum tax rate of at least 15%. But of course, this comes with with a caveat that unilateral taxes need to be rolled back. We've already seen that the US, on the cusp of this G7 agreement, has also suspended the additional tariffs it was proposing to lay on Indian goods for at least 180 days to provide additional time to complete the ongoing multilateral negotiations. So we have a lot to talk about. I cannot really complete an introduction in 2 or 3 minutes, but I think this is what we are really trying to talk about today. Of course, the fate of tax treaties is again a question mark. Is it an MLI over an MLI? What timelines are we really talking about? How is the UN model really going to play its role in the negotiations which are going on? So that's really what our discussions are really going to be based upon today. And I think to start off, I'll request, Mr. Bansal to, to give his presentation on Article 12B. And again, a very quick introduction of Article 12B in the UN Model Committee. This is a relatively simpler approach which has been proposed as compared to the complicated Pillar 1 proposals. And it's based on a withholding tax proposal. So it offers a bilateral solution as compared to a multilateral solution. But I'm going to let Mr. Rajat Bansal talk more about it before we move on to the even more complicated topics of Pillar 1. Sir, over to you.
Thank you very much, Parul, and thank you, Mihir. Thank you, Dhruv. Thank you, my co-panelists, and thank you to everyone for allowing me to explain about the UN Tax Committee solution to this vexed issue of taxing the digital economy. And so let me straight away go to my presentation, and which is a very simple presentation to explain this UN Tax Committee solution. Okay. Can we see it? It's visible. I hope it is visible. Okay.
Yes, we can see it. Yes, please go ahead.
So I'm sure that most of us here are familiar with the issue, which is about how to tax the digital economy, or how to tax the digital companies which are transacting their business through the new business models of using the digital technology. According to me, there are 4 issues here, and I have simplified them like this. That first is whether to tax, whether there should be taxation of digital economies. And this question took a lot of time to get settled down, and I think around 20 years or more than 20 years have been spent in this alone. But now, despite different views, ultimately, I think that everyone agrees that it should be taxed. And people do talk about, still, I find that whenever there is they are not comfortable with the solution being proposed, they will go back to whether to tax. But more or less, this is settled that it should be taxed. Now, what to tax? Now, here one could tax services, one could tax goods, one could tax all or some of them, and related issues of ring fencing, as you must have heard, that digital economy is actually the entire economy now. So why only tax a part of it, and why not the entire everything? How to tax? Now, this is what Parul was referring to, or Dhruv was referring to. It is about the 2 different kind of approaches possible. One is the centralized approach or multilateral approach, where we are talking about pooling the profits of a M&E group together and then distributing them at a centralized place and in a centralized manner to every country where the presence of that multinational group is there, where it is doing business. And second would be the traditional approach, as we have been doing, each country taxing it, as we do for the multinational business profits at present. Then how much to tax? That's the million-dollar question, because ultimately the proof of pudding is in eating. So whether it should be only a portion of non-routine profits or something else. This is referring to the solution being talked about in the other forum, where there is a proposal that only the non-routine profits and a slice of that should be taxed. Then the related issue is measurement. How to measure it? It's a very difficult question, because what should be taxed, measuring that with respect to a particular market economy where it doesn't have an office, where it doesn't maintain accounts specifically for that place, is difficult. So everyone is talking about approximation, every approach, be it the multilateral approach, be it the UN approach, and there is no other way. It has to be an approximation. Now, why alternative approach was needed? I'm talking about the UN Tax Committee approach. Why was it needed when there was already a approach being talked about, or in the other forum? So 2 reasons for that. First is complexity issue, which I'm sure most of you would be familiar with and must have heard about it. About the other forum solution, complexity has been a matter of concern, I should say, and there has been an effort to simplify it in the other forum also. But the UN Tax Committee looked at this aspect in a very specialized manner and attached a great deal of importance to it. Second and very important aspect is reasonable share for market jurisdiction. Reasonable and fair, I would say, share for the market jurisdictions. That's very important, because ultimately, if you do not get what you deserved is not the right word, what you expected or what should be given to you, then it's the whole exercise loses its meaning. Next issue is journey of Article 12B. In the UN Tax Committee, if some people might not know what it is a committee in the United Nations of 25 experts working in their personal capacity, taken from 25 countries. And the mandate of the UN Tax Committee is to work especially in the interest of developing countries. That's very important, that the UN Tax Committee has to per se working in the interest of developing countries. Tax challenges of digital economies was taken as a work stream in the present life of the membership in 2017. Then initially there was a debate, quite a bit of time was spent in discussing whether we should do something. We should just observe the work going on in the other forum, or we should do something more. A lot of time was spent in that. Then in April 2019, after some of us from the developing countries really pushed for it, we decided that we should work independently, because what we might get out of the other forum may not be suitable for developing countries, and time is running out, and this committee's life will be over. So it has to run concurrently. So we started working independently. And how do you work independently? That was the issue. So a proposal was made by me only that we should allow the members to submit their independent proposals, because everyone there, the members are from different countries, and quite a few of them are from OECD countries, from developed countries, and obviously they have, everybody looks at the issue from their point of view, from their country's point of view. So getting a unanimous view at the beginning while tabling the proposal was impossible. So therefore we decided that members should bring their proposal. And before the 20th session, I made a proposal and submitted it to the committee, which is in public domain. And this was discussed in the committee, and it was decided that we should form a drafting group to take it further. And it was taken further, and I'll not go into those details. We refined upon, firstly, we approved that article for insertion in the UN Model Tax Convention in the 21st session in October 2020 in principle, and thereafter we refined the text of the article and the commentary further, and finally, very recently in April 2021, in the last session of this membership, we approved that article and its commentary. Now, why modify tax treaties? The reason is that taxing rights flow through the domestic law, and treaties override domestic law. Treaties do not permit taxation if there is no permanent establishment or fixed place of business or agent, as you all might be knowing. And therefore, there is a need for treaty modification, which would also help in eliminating the double taxation, because tax treaties are facilitator for that. So therefore, there was a need to modify the tax treaties, and United Nations Tax Committee, which is responsible for updating the UN Model Tax Convention, which has a great deal of persuasive value in treaty negotiations all over the world, took it upon themselves to modify the UN Model Tax Convention. Now, what are the features of Article 12B? In this slide, I have tried to capture that. The first is the scope. The scope of the article is to cover automated digital services, meaning thereby services with minimum human intervention in the market jurisdiction, and those which are rendered through the internet or other digital networks. Gross basis or net basis taxation are two options given in the article, which is its versatility, I would say. That for simplified implementation, one can deduct tax on gross basis at a rate of 3 to 4% recommended in the commentary. And for those who have losses or who want to pay tax on net basis, they can choose the net basis option, where there is a deemed amount which will be taxed, which is 30% of the profit, determined by multiplying the local revenue with the M&E's overall global profitability. Article 12B is based on, it takes the income to accrue where the payment is made from and not where the users are. This is also a part of simple solution, and there are other reasons for it, which we may discuss maybe later. Lastly, there is interaction with other articles like royalties, fees for technical services, business profits, where there may be overlap to lay down a clear rule which will apply when. Now, concluding remarks, some aspects I would like to bring to your kind attention. First one is that United Nations Tax Committee has looked at this issue no, it's not up to us to suggest that tax digital businesses. This is something to be decided by the countries concerned, matter of their domestic law. If you have done that, then the United Nations Tax Treaty solution comes into play. No interlinking with other issues. This is a standalone basis solution. I'll not say anything further on this, but it is clear that we are only confining ourselves to this issue, not mixing it up with other problems. Traditional approach for M&E taxation in a decentralized manner. I would emphasize that this is akin to what we have been doing so far, Article 5 plus Article 7, whereby we tax the multinational profits. This is just an extension of that, something the countries are used to, especially the developing countries. Therefore, it will be easier for them to adapt to this new approach. Implementation will be through bilateral negotiations or maybe a multilateral instrument like the MLI, which if can be advised, then countries can swiftly bring in this article into their tax treaties. Lastly, very important, I see it also there is a possibility of covering the unilateral measures, equalization levies and DSTs, if they are covered in the treaty amongst the covered taxes by remodeling them in some manner, and then the elimination of double taxation will take place, as well as this whole issue of unilateral tax measures can be taken care of. So with that, I'll stop here. And I hope I have been able to convey to you the major features of Article 12B. Thank you very much.
Thanks a lot, sir. I think that was a very precise and very good overview of Article 12B. We've all had the opportunity to also study, the manner in which Article 12B has been introduced. First of all, we are really honored and proud that we have you in our midst of having brought this proposal as part of a member of the UN Tax Committee. But I think we'll move to the questions later on. I'll now request Dr. Leopoldo, if now you could talk a bit about Pillar 1. We've heard Mr. Bansal talk about the approach under the UN model. And let's talk about your views on how Pillar 1 really works. What are the technicalities around it? Is it really more complicated than what it is being made out of? And maybe we can also discuss the G7 proposals alongside or later on.
Yeah, thank you so much, Parul, and I'm here also for the nice introduction. It's a pleasure for me to be here. So good evening for those who are in India. Good afternoon for if there is someone here in Europe, and also good evening to all my co-panelists who are fantastic. I'm also very, very thankful to learn that I'm with today, chairing this panel with Mr. Rajat Bansal, and because I have many questions about Article 12B and many comments that I will try to raise here, hopefully in a very friendly and soft way. Okay, so let me now go straight forward to my presentation. So let me
Leopoldo, if you could take your mouse at the bottom of the screen to the bottom right of it, you will see there's a plus and minus scale, and right next, yeah, there.
Do you see it now?
Yes.
Perfect.
Okay,
Perfect.
excellent.
Thank you.
Okay, so let me start, because when I was invited to talk today, I thought how to frame this discussion in 15 minutes, which is quite a challenge. So I thought the best way actually is to pose these ideas about Pillar 1, understanding as well what are the alternatives on the table. So for that reason, it's quite interesting for me to hear first the thoughts about Article 12B, which is one of the alternatives to Pillar 1. And the other one, we also know it, which is digital services taxes. So the first question is actually, how did we get in here? And even though this question can sound quite basic for many of you, is a crucial question in all this discussion, and we should not forget about it. And we need to go back hundreds of years ago and try to think how businesses were done by then and how businesses are done today. So we have today the issue that businesses can or they not need to have any physical presence in a country, which poses a challenge in the way treaties actually work. So the whole concept of permanent establishment, which was one of the pillars or it is still one of the pillars of our treaty network, is not longer suitable to answer the question what we do with a country where business profits are generated because there is a strong economic presence in that country, but there is nothing there, nothing physical there, no office, nothing that we can call a permanent establishment. And this is actually the reason of the discussion about Pillar 1. So if we want to put this into a context of, let's say, a political context, I always tend to divide the world in two. I always say we need to look what is going on in the US and what is going on in the rest of the world. And this is actually what happened exactly in this whole discussion that started back with the OECD-based erosion and profit shifting project. If we remember, Action 1 was the first attempt to deal with the challenges arrived by the digitalization of the economy, and particularly with this question of what we do with business profit being generated in a country where there is no physical presence. Nothing was done by between 2013 and the OECD BEPS and the final report that they came in 2015. But let's say in the background, a lot of things were going on, and particularly in the other side of the world, so the United States, which to a certain extent took the lead of what they wanted and what they wanted to impose as well as a vision to the rest of the world. That's the reason why we had legislation passed in the United States, like GILTI or BEAT, now CHILD, which is actually informing what we know today as the Pillar 2 and this whole idea of contracting, you know, this so-called race to the bottom in the effective corporate income taxation. But now with Pillar 1, we had indeed an important evolution, which came precisely with this whole discussion on the Pillar 1. So Pillar 1 is to a certain extent a summary of different proposals that they were discussed for a long period of time. So Pillar 1 is not something that was born from one day to another. It was a sort of adaptation to what was going on, to which extent we could, all countries in the world, to really sit and agree on a sort of a global agreement. So Pillar 1 is a culmination, is a climax in this whole discussion about what to tax and how to distribute, you know, these revenues among multinationals worldwide. It is a very technical proposal, and we all know that. But in the core of it, we know that the question that is trying to be answered is nothing else than the question about how we tax the profit generated by a company in a country where there is no physical presence. So if we put aside all the technicalities, we come back to the basic. We are trying to answer the unanswered question of, we have a concept that is no longer suitable to answer the questions about how we tax profits in a country where there is no physical presence. Now, Pillar 1 has these two amounts that they answer two different, or they respond to two different issues. Amount A, which is basically the new nexus rule that is giving us the opportunity to say, you know, how much countries, you know, can get when there is no enough physical presence. And amount B, which basically I would say answers a question, an old question about how we actually evaluate remuneration for marketing and distribution activities, which is a a long-standing discussion in many developing countries, and perhaps the source of a lot of tax disputes in developing countries. So it has these two particularly interesting elements. Let's see first amount A. Amount A is giving us the answer, as I said, of where is the nexus. What is the nexus that we give to this source of market jurisdiction in order to tax when there is no physical presence? And in this regard, amount A has a series of segmentations, so differentiations that are done, which makes the proposal quite complex, I have to say. Even though most of them, they have a reason to be, and they respond to a clear policy. The first distinction that we have to do with amount A responds to this distinction between consumer-facing business and automated digital services, which are indeed the services that are within the scope of Pillar 1. Consumer-facing business, it has a reason because it's of course, we could ask ourselves, most of the digital services that the influence of users actually or consumers, it has to be, with consumer-facing business. Although we also need to consider that more and more the confusion between what is a consumer-facing and what is not a consumer-facing is becoming quite a complex exercise. Automated digital services, as Rajat mentioned, it refers, to this kind of services where there is almost no human intervention. Of course, in my view, this answers the question of how we expand the scope of Pillar 1 to also get most of the services that are being included within the different digital services taxes that are being generated in countries today. So both have reason, but they increase complexity as well. If we go into the calculation, we also have a problem of complexity because, and particularly in terms of revenues, how much will be allocated to market jurisdictions. The main reason for this is that we have this very complex, way of thinking, which is, first, we distinguish between routine and non-routine profits. So a percentage of that will be done through a formula. So that's the innovative part of it, right? And once we have that percentage of non-routine profits, it is not the full amount that is going to every single market jurisdiction. We need to determine that based on local and global sales again. So in a very practical exercise that I wanted to put here, we don't have much time for this, but in this very basic scenario where we have global profits for 30 and global sales for 125 in this group of including 3 different countries. The country in orange is basically the country where there is no physical presence. So basically we have only amount A. The amount of potential profits that will be allocated to that jurisdiction is quite minimum, is only 1.54 out of 30, which give us, in this oversimplification, a little bit of a look of what will be the situation of market jurisdictions after Pillar 1. Amount B, on the other hand, as I said, it has a different orientation. It simply tried to approximate, the results of the arm's length through the transactional margin method. So basically, it's a way to solve through a formulaic approach all problems related to how to evaluate marketing and distribution activity. So I see at least this amount B as a sort of a very positive step, especially for developing countries. What are the alternatives that we have on the table? We mentioned one a few minutes ago, Article 12V, which has these characteristics of being a withholding tax on gross income with a very limited scope, automated digital services with the opportunity to also require taxation on net basis, and which I see personally as a very positive step in the sense of eliminating complexity and I do agree also with Rajat in that way, but I also think that it has one particular problem, which is implementation. We have to negotiate all treaties one by one because there is no UN MLI, and that creates, of course, a problem of enforceability in the end of the day. If we will have just a few countries having Article 12V, evidently nothing will be changed. From a technical perspective, I would just like to pose a question. Was it really necessary to have an Article 12V when we could have, for example, just change the interpretation of Article 12A and include within technical services, automated digital services? Perhaps that would have avoided this renegotiation that we need to face now treaty by treaty. It's just an open question. The other alternative is digital services taxes that brings its own problematics, and especially we can see it here in Europe. Even though I must be fair and say that I recognize that the positive side of digital services tax is an efficient tool to tax location-specific rents, because we have an amount of consumers that they cannot move. So this is very, very similar to what we have with extractive industries. It can also encourage, a global agreement. I do agree also with that argumentation. And also we need to think about what developing countries are doing, thinking in the implementation of digital services taxes. In Kenya, for example, they are thinking about justifying the digital services taxes as a way to repay IMF loan obligations. So it can be that it triggering, different policy aims than simply, targeting big tech giants. In a negative way, of course, we have incompatibility with treaties. Probably Drew will speak more about that. There is a problem with ring-fencing the digital economy. And I have written about it as well, which is a problem, but particularly the problem of discrimination that is generated by digital services taxes. They operate with these high revenue thresholds. So basically they ensure that only few companies, basically companies that are not resident in the country imposing the digital services tax, is affected by the tax. And that has implication under European Union law, at least within the European Union, but also under WTO is a question that we can also raise. There is still a lot to say about this. I think that when we put together Pillar 1 and Pillar 2, I see two completely contradictory alternatives. So I tend not to see them as something, as a package. And raising the question, can the Pillar 1 survive in this context? I think hopefully it does, because Pillar 1 is for me the best option available today in comparison to what we have with unilateral digital services taxes, more double taxation, and perhaps also even with Article 12B that comes with its own problematics, particularly with the capacity that the countries they have to renegotiate treaties bilateral. Okay, so having said that, thank you very much. I hope I didn't take extra time, and I'm very open for questions later.
Thanks a lot, Dr. Leo, and I think a very nice comparison between Pillar 1 and Article 12B. But since you brought in that comparison and you raised a couple of questions on Article 12B, before I turn to Maya and to Dhruv, Rajat sir, I think there are two questions which Leo raised in his presentation on Article 12B. One was, did we really need an Article 12B? Could we not have just done an amendment to 12A? And secondly, is it how feasible is it really to negotiate or do this through a bilateral arrangement and do a country-by-country negotiation? So would love to get your thoughts on these two aspects and any other aspect that you would want.
Thank you, Arun, for allowing me to come in again. And thank you, Dr. Leo, for this wonderful presentation on Pillar 1 and Pillar 1. Basically, Pillar 2, you did not go into the detail. on the first aspect, whether Article 12B was necessary, I would say it was. Firstly, to give a clear signal that this is addressing the digital economy problem, for which the subcommittee was constituted, for which we decided to work on. And that's a very small aspect of this. But first, let me put it the other way. We have, while drafting Article 12B, clarified that how it would work vis-a-vis Article 12A, and we see a very small area of overlap, and that overlap has been addressed. When I say that we see small area of overlap, then it means that this is something different, which needed to be tackled through a separate article, through a separate regime. So that's what we have done. And if there is a possibility of overlap with Article 12A, and therefore to take care of that, inter-C priority between the two has been laid down in the article drafting itself. So that is for the first aspect. Second one, about the difficulty foreseen in negotiating so many treaties. As I said, there is a possibility of a multilateral instrument which can be signed simultaneously by various countries if they are willing, and thereafter it can be swiftly introduced in all the treaties which are covered by that multilateral instrument. And see, here I would like to say that any solution that we are thinking of otherwise, what is it that I'm not very clear what is the way forward for that. Suppose there is a consensus, then does it mean that all the people, all the parties that are there in that consensus are bound to sign that later? What happens there? If Dr. Leo can elaborate on that as to whether, what exactly does it mean? Like in the case of the other multilateral convention we recently saw to implement the BEPS measures, there the instrument was drafted by an ad hoc group where 100 countries participated, and thereafter it was open to all to sign and to ratify. It was not mandatory. So there also, and if you see the result of the implementation, countries have chosen the minimum standards in all cases, but for the rest, they have preferred bilateral negotiations. So, because ultimately treaty negotiations is a matter of balancing things, and I've been a treaty negotiator for very long, and so anyone who has negotiated treaties knows that no one wants to negotiate a treaty without balancing various aspects, without give and take, without a package deal. So I think that was the reason why in the other multilateral instrument, we did not see a great deal of adopting for all the provisions that were there. There were as many as Article 3 to 17 are the substantive provisions. But if you pick up and see how many have been really adopted, I remember that the adoption ratio was as low as 15%, 20% for various articles. So my question to Dr. Leo is, how are we sure that the other solution is, or if it is there, then please tell us, because I am not aware, I do not participate in those negotiations, as to whether we are sure that it will be implemented by all the participants which are there at the moment.
And that's actually the biggest controversy, even after the G7 communication, which Mr. Bansal has mentioned he would not be able to talk about. But nonetheless, even after the G7 agreement and with the wait for the G20, meeting happening in July, Maya, I'll just get you in here, to talk about India's journey and Indian, outlook specifically on this whole G7 issue. We have an equalization levy, we have an SCP. We are talking about working off a US proposal of taxing the topmost 100 companies. Will India be a net beneficiary? Will we be able to roll back our EL and SCP? What do you think?
Thanks, Parul. And I'm really benefited from the views that Mr. Bansal and Leo have already laid out on both the proposals. And and having seen the different points, it falls upon me now to kind of I think the question on a lot of companies' minds and a lot of the people who are attending is what happens next. So I'm going to quickly recap how we got here from the Indian perspective, and of course this is based on, I'm not an insider, this is based on what I've been seeing, based on what I've tracked the last couple of years. So all of this started with, of course, as Leo said initially, that there was a perception that companies don't have a presence here and they need to be taxed. But of course, when Web 2.0 happened, companies did actually started putting a presence in India. A lot of the companies do have a presence, but it was still not felt sufficient for the revenue collection and allocations here. So I think the debate has now shifted more towards a higher allocation towards market countries, and that's the pivot with Web 2.0. Now, in this process, India first came out with the equalization levy, the 6% levy in 2016. Then, we subsequently expanded it and added a 2% levy last year, and we have had a further sort of expansion through some clarifications as well. Now, the way to sort of see this is, and I do see a lot of this as not necessarily the most revenue generating sort of proposals, but they were, I think, signaling and pushing for a larger goal, which was to have the legitimacy of market jurisdictions right to tax a portion of this income. And I think we have fairly succeeded with the G7's admission on that count, saying that at least there is a right to tax. And I think now the negotiation remains on possibly what is the percentages, what is the allocation, right? And that's a detail that needs to be drilled down into. But having said that, these have been pretty much unilateral measures, while multilateral consensus was being strived towards, and the UN model is a bilateral measure that come up. Now, each of these has its own limitations and challenges, and that's where I will then come back to saying what is the future then, right? What has happened with these taxes is, yes, there has been increasingly more tax collections at the Indian level because of equalization levy, but it has in some ways failed in its original objective of bringing in a simple and a certain regime, because I think we are all aware that at least as practitioners and questions that we get from clients on what is covered, what is not covered, I think there's quite a bit of gray area surrounding that despite the clarifications. So in that sense, and some of the aspects of DSTs Leo also touched upon, I think some other difficulties with DSTs are that costs get passed on to consumers. It's not necessarily equalizing the level playing field. And it was always intended to be a short-term measure till there is multilateral consensus. So it's not and just relying on a unilateral measure is not the best way for a stable long-term tax policy globally also. That's not going to be a stable tax policy regime, because each country will come up with different requirements. Already we see a very different scope, revenue thresholds for the DSTs around the world. This is likely to become a high compliance and cost for and concern for companies, the level of compliance that they'll have to do if this becomes a global regime. So it's not ideal, and it was a stopgap measure pushing towards a multilateral solution. The UN model, again, I think bilateral solution, I think it was I really appreciate a lot of the technical work that's gone into it, but at the end of the day, apart from the technical issues that Leo had raised, I think one issue that bothers me is, at least when we talk about scope, and I know Rajat sir also said that some of these items may get covered, the DST get covered within the scope of the UN model. But the biggest difference is, if we take the Indian equalization levy, it pretty much covers everything, right? Including offshore to offshore transactions in advertising services are also covered. Now, if we are restricting it only to payments from India, I would see a huge chunk of equalization levy transactions still not covered under the UN, and that gets into other questions of, are we the reason why we started this debate was, from an Indian perspective, government perspective, was that there are advertising revenues which are not necessarily being captured or taxed in India, which was the bulk of the foreign companies' revenues, which again, whether it would be covered under the UN model still remains an open question in my mind. So, and how will the UN model coexist with equalization levy? It's not an ideal regime again. And from a practical perspective, I think we've been having this debate for 4 years. I think the political will is gathering around it. There is a lot of, I think, push to try and close it. I think if we go down the UN model, getting consensus, and Rajat sir, I think kindly laid out how the process is working at UN. It's 25 members in their personal capacities, and compared to the way consensus is building around the other proposal, pillar one, I think it's going to be tough to at this stage get that buy-in to push this through as a practical solution in the short term, right? And these are considerations that we need to keep in mind when we, again, coming back to Leo's point as to what is the best solution we have at the table. It's not perfect, but what is the best solution that we have today at the table? So the way I see the G7 sort of situation, and where I think India should be thinking about going towards, is that the context today is that the US, I think, wants to raise domestic taxes. They want to fund the COVID relief, and they are and as a part of that, they want to expand the minimum taxes to ensure that companies don't invert. So they have a strong interest in ensuring that the pillar 2 comes through. And what I read from this is that they're willing to concede on pillar 1 if it makes pillar 2 go through for them. And that's what I think we need to sort of, from a government perspective, if I would suggest maybe capitalize on the timing of that. And maybe the negotiation may go down to what the proportion of allocation, or on what level of profits should be allocated. But at the end of the day, I think this is something that a multilateral solution that is targeting, I think, not just digital companies, because that's the other point, which is that the UN model also focuses on highly digitalized companies, on ADS, except for SEP and EL cover all sorts of transactions. So I think the intention for a 10-year, 20-year period, without looking at the past and trying to tax the big tech companies, I think if we're looking at the next 20 years, this digitalization is something that's going to be very tricky to enforce under even the older pillar 1 proposal. So I would be in support of a wider proposal that should reduce some of the complexity, make it more administrable, and also widens the bucket, I would think, from a developing country perspective in the future as to what may fall within that bucket and be up for redistribution. So I would say there are advantages there. And even on pillar 2, I think, yes, there is, from whatever I understand and what we have seen, there is an upside for India there as well. It's not that by agreeing to the current proposal we lose. Of course, there are certain other technical aspects where, subject to negotiations, there could be a higher gain, but I don't think any country loses out of the pillar 2 proposal at this. So that's a very quick take on, I think, where we are, and I think what we should be pushing towards as a country and to close this, because otherwise we can't spend another 4 years figuring out another proposal and trying to get consensus. And we are on a clock, literally. So I think even though it's being driven by other countries, and definitely proposals would be in their favor, we wouldn't say something that goes against themselves. I think what we need to assess is there a benefit for us? What can we take away from this and close?
Great, May. I think we can probably have another session on, when it comes to Indian context, and without really, since we're really losing time here, Dhruv, you are the expert on tax treaties, and, 2 questions for you. One is, what is the future of tax treaties? We have bilateral tax treaties, we have an MLI, this consensus, are we looking at another MLI? Are we talking about another 3 years to go by before, there's an, is it really the, a tax practitioner's dream that we're talking about here? And of course, a taxpayer's nightmare. And at the same time, DSTs, how do you look at DSTs and tax treaties? Over to you.
Thank you very much, Parul. There's been a pollen storm over the last few days in the Netherlands, which has resulted in me getting hay fever. And so pardon me if I'm breathless throughout this presentation. But hay fever is not the only reason why I'm breathless today. There are a few other things that have taken my breath away, both positive and negative. So let me first start with the positives, that have taken my breath away. And that is on our panel. The first one is Rajat Bansal himself. I mean, first of all, I have to say something. Having been, a contributor to the Committee of Tax Experts at the UN for a number of years, at least when the physical meetings were being carried on, the way in which the UN Tax Committee works is that Working Party 1 or the OECD members are extremely streamlined and well coordinated. There was a point of time where out of the 25 members, 15 were developed countries and 10 were developing countries, which sort of boggled one's mind. How exactly is one supposed to secure developing country interests where a highly streamlined and coordinated majority were developed countries? And in the face of this, it seemed, and I've seen discussions about fees for technical services going on for a very long time. What Rajat has really managed to achieve over there is nothing short of remarkable. It's really fascinating. So first, he's of course proposed Article 12B, and I remember the tax circles at the UN and in academia saying, "Oh, Rajat is being too optimistic. Does he think the developed countries at the UN tax committee are going to let it pass?" And in the last couple of tax committee meetings, I think Rajat ran circles around them. They didn't quite know what to do, and he got 12B approved, which is just really quite incredible, given how much resistance there was to even discussing Pillar 1 or the digital economy at the UN. As he said, the pressure was very much on to just wait for the OECD to declare what the right approach would be, and the UN should follow. Secondly, something that was stuck in discussions forever was Article 12A, which is fees for technical services, which actually Pragya Saxena also pushed for, and Rajat brought it to fruition. The third is, well, it's not a provision I like very much as a tax practitioner, but nonetheless, he managed to get it through. And that deserves respect is indirect transfer provisions in Article 30. So these are, some of the positives that Rajat has brought through. And whether I like the provisions per se or not, I think as an Indian representative, you've made us all proud, Rajat, and thank you very much for that. I mean, if this were a physical conference, I would have asked everyone to give you a round of applause, but I think we can accept a virtual round of applause for you. The second positive, and I'm now running thin on how many positives I have overall, but I will speak about it, and that is Pillar 1. And Leo can be critical about Pillar 1. All of us can find criticisms for Pillar 1, but I think it is quite an achievement that the world is heading towards a certain consensus after 20 years after the Ottawa Convention came about. And also what the MLI has now done is it has created a framework of the Conference of Parties, which will help us over a period of time fine-tune Pillar 1 if there are found to be any troubles, teething troubles in how it is implemented. Of course, how it is implemented is anyone's guess, and I have some, and that is a good segue for me to talk about how I think Pillar 1 will sort of cohes with tax treaties. Currently, tax treaties are all they all function at a personal tax level. You need to have generally a resident of a contracting state that earns income for a tax treaty to be relevant. And insofar as Pillar 1 is concerned, you're not talking about the separate entity principle anymore. You're talking about a group level residual profit, which is thereafter distributed amongst market economies. So I think the traditional separate entity principle or the personal tax framework paradigm that tax treaties function with will simply not work with Pillar 1. Nonetheless, how do we now implement Pillar 1? Do we leave countries free to interpret Pillar 1 the way they want to and tax it the way they want to? I don't think that's really going to work out very well as well. So I think we need to use a tax treaty mechanism by which source countries do get a taxing right, but without reference to a resident recipient, a separate entity earning the income. And I think this will most likely be achieved through perhaps indeed a second MLI, which basically will lay down a minimum standard for bilateral tax treaties, in which there could be an addition to Article 7, in which you have an impersonal tax provision. most of the provisions, as I said, require a resident recipient, but you can secure a source country's right by delineating income, irrespective of who earns it, but figuring out where the source of that income is and allocating taxing rights to that particular state, and securing the source country's taxing rights to that effect. So I think one will have to devise an impersonal tax distributive rule, which perhaps will go through all the bilateral tax treaties that we have currently, about 3,100 of them, or maybe there will be a separate multilateral instrument that will determine how these source taxing rights are allocated. So I'm quite hopeful that there is room for tax treaties to evolve, because tax treaties have more or less followed a certain standard for the last 100 years. So as a lover of tax treaties, who mumbles about tax treaties in his sleep, much to the chagrin of my partner, soon to be wife, I'm quite glad that there'll be more to think about in how tax treaties will function. Also, now I come to the negatives about DSTs and equalization levies. And before I get there, let me just ask a question. Most of us would think that equalization levies are a new invention per se. But what exactly are we trying to equalize is the question that we're asking. Equalization levies are nothing but levies that seek to equalize lost tax revenue for a country. And so through the digital economy, that the permanent establishment standard was no longer relevant, and that led to a loss of tax jurisdiction for a number of source states. And that loss of tax revenue was sought to be equalized through the equalization levy. Is this really a new construct? If one thinks about, most Indians over here at least will be aware of the dividend distribution tax, which has recently been abolished. But what was the dividend distribution tax? You had the dividend distribution tax, and your dividend taxing rights could have been affected by tax treaties. And you can equalize that by simply levying a tax on the undistributed profits of the company distributing the dividends. And the question then arose, yes, you did equalize the loss of revenue that you would have under tax treaties by shifting the burden of tax on dividends. Parul has given me an instruction that I need to wrap up, so I will wrap up very quickly. So that the DDT was basically an equalization levy, and there could have been some very specific circumstances in which Article 10, paragraph 5, and our audience, I invite them to read it carefully, could have actually restricted the dividend distribution tax. And that could be in a situation where an Indian company, an Indian incorporated company, were a dual resident and the place of effective management were elsewhere. Then in Article 10.5 of the tax treaty between the winner state and the loser state would indeed have prevented India from applying the equalization levy on the undistributed profits of this dual resident company. And so I think it is very important. Why am I talking about it? Because I think a lot of countries have got a very nice source of revenue. And once one smells revenue or tastes revenue, like the Lay's chips, countries cannot just have one. They want to continue with it. And so I think also the future of tax treaties is bright in that respect, that we will have to innovate a tax treaty provision whereby such equalization levies or DSTs are indeed prohibited. Much like Article 10.5 is a negative source rule, we need a negative source rule for DSTs as well. Final comment is with respect to Pillar 2 and the minimum taxation, which I find rather troubling. I was reading in the media that there are some non-profit groups which are asking for a minimum taxation of 25%. And whilst it may seem like it's only fair to do so, corporate taxation per se is very distortionary. And if you have companies paying large amounts of taxes, then remember, developing countries, these companies are not going to be able to employ that many more people in your economies. I think one has to now move beyond saying that, corporate taxation is the main source of revenue for a company. But if you have a situation where you have higher personal taxation, the same revenue that you lose through corporate taxation can be very well regained and more through higher tax rates on individuals who are able to earn a lot more money. I can go on and on for hours and hours about the distortionary effects of corporate taxation, but the last part is we have to remember that with Pillar 2, where all incentives are now characterized as bad and harmful, it's antithetical to Action 5, which talked about the modified nexus about what incentives are harmful and what incentives are not. And since 1998 through to 2015, the OECD worked incredibly hard on preventing harmful tax competition, but at the same point of time, leaving room for good incentives. Now it seems that all incentives.
Drew, I'm so sorry.
All right, I will stop.
We are already 10 minutes, almost 10 minutes over the time. I know there's
Right.
so much to discuss and so much to share. So we will continue that in your own meeting room, Drew. And Parul, let's have a concluding remark from you, and then certainly let's close it. It's already late in India. Although I can go on, I'm in California for a whole day, Drew, like you and me, right?
Yeah.
So
No,
thank
thanks a
you
lot.
again.
Yeah.
Go ahead, Parul, please.
No, thanks a lot, everyone. Thanks to you, Mihir, and special thanks to our external panelists, Dr. Leo and Mr. Rajat Bansal. I think it's been a very interesting conversation. 1 hour is too less. We've tried to pack in too much into less, and hopefully we will have a digital, whatever month it is, event which is going to focus only on tax, and we will not have an end time to that. It'll just be an open-ended session, come and go as you please. So, but exciting times, exciting for everyone who's part of the tax fraternity. And let's see which way we end up here. Is this really going to mean an end to the BEPS OECD project? Is there more to come? Is there a BEPS 3.0? Let's wait and watch. Thank you.
Thank you, Parul. You can see the passion, right? You can see the passion with which people are approaching this thing. And it's so good to see this passion. There are so many interesting things, right? Whether we should have bilateral discussion, we have even unilateral issues, and multilateral solution. Where do we go? And right, everybody is coming out with so many different proposals. Should we wait for the base proposal? Or should we go with what is on hand? I think it's a great discussion. And Parul, I love your idea of having a separate digital economy focus on taxation session. Maybe separately, we'll definitely look into doing that. But I want to take this opportunity to thank all this passionate people bringing so many different discussion to the table. Thank you, Parul, for steering this great committee and steering this great panel. Of course, Dr. Drew, Maya, Dr. Leo, Mr. Bansal, we are very fortunate to have you all here and talk about this from multi different perspective. So thank you again. Just for the audience, we have applied for MCLE, CLE credit with the State Bar of California and New York. So if you wish to receive credit as a CLE for this, kindly write to Lynette.h@Nishith Desai Associates or nishithdesai.com. And the code that you need to use is 91001, which is the code for mention to that you have attended this session. With that, tomorrow we have 2 more sessions. The last day of Digital June, we have 2 great sessions. The first one will focus on the human resource issue or the labor law issues, or because shared economy, how do you deal with these different labor law issues that you have designed for traditional industry, but what does that mean in digital economy industry? Where are they employee or they are just a contract worker? All kinds of issues that we are going to have a great panel tomorrow. And then the last panel, which we should have actually individually on each of this sector, is just a sectorial perspective on digital economy. We have so many sector evolving: health tech, fintech, media and gaming, and edutech. There's so many opportunities, agri-tech, whatnot. We are able to bring that all together in one session. Of course, it'll be just a flavor tasting, but at some point of time, we would like to do individual sessions on each of those sectorial issues. So again, I look forward to seeing you tomorrow. Thank you again for joining us. And now, please, you can join the speakers in their own breakout room. So just click on join in the breakout session to whichever speaker you want to join in. And you can go from one speaker to another speaker very easily. And I want to thank our technology team for us to allow this kind of platform to happen. So again, thank you and wish you good day, good night, and look forward to seeing you tomorrow.